Good morning. If I can get everybody to take your seats, we're going to get started. Yeah, where get the gongs? Just going to wait 1 second for people to come in from the hallway. Good morning. I'm David Wessel, Director of the Hutchins Center here at Brookings. On behalf of our partners at the Brandeis International Business School, Rosenberg Institute of Global Finance, Dan Bergstresser, Rich Reifel from WashU in St. Louis, Olin Business School, and Justin Marlowe from the University of Chicago's Harris School of Public Policy. I want to welcome you to what's the 12th Annual Municipal Finance Conference. Although it began before we got involved, we're very proud to be involved in it. And we're extremely happy to be back in person, although anybody who wants to is watching online, so be careful what you say, because you could become viral if you're not careful. We have a great program. It's kind of crowded today, and there's some logistical challenges, so I just want to go over them briefly. First of all, if you haven't found the restrooms, they're out straight that way. And you all have name tags, and our security people asked me to ask you to wear them. And if you could try and remember to wear them, bring them home and wear them tomorrow. I've never succeeded in doing that in any two-day conference, but maybe you'll be better than me. So we have one session in here this morning that I'll introduce in a moment, and then we'll break for lunch around noon. And we're building on something that worked well when we had the conference virtually, which is we're going to have informal discussions over lunch. We've got some topics. I'll explain them later, and there's going to be some signs. 4 different things. There'll be a box lunch here. You can take your lunch. And those are not programmed, although we do have one of our organizers of the conference will be in each room, but they're spread out throughout the building. And it's a little complicated because we have some construction, so I'll do that later. And then we'll come back at 1 o'clock. But at 1 o'clock, we're going to have concurrent sessions, one on state and local tax issues in here, and one on muni bond market issues on the second floor. We'll direct you there. And then we're coming back in here. This is going to be a challenging day, to hear from David Schleifer of Yale Law School on his book, and then to have some sessions in here. So my staff will be happy, the Brookings staff will be happy to guide you through that. And I want to call out the people who make this possible: Hao-En Chen, Megan Waring, and Stephanie Sensula. Thank you. As you all know, there's always a lot of logistical issues in arranging any conference. This one is no exception, and I'm really proud of how well it's gone so far. Of course, we're only 5 minutes in, so. The first panel today is on climate change and municipal finance. Dan Bergstresser is going to moderate it, and I'll leave him to introduce the speakers and take it from here. So, Dan, the floor is yours.
There's a note here. It says "Speak into the mic." Welcome. Can y'all hear me? Okay. I'll just remind everybody that this is being live streamed as well. So anything that you say, even in the back, might get picked up and carried over Zoom. So be aware of that. It's a delight to be back in person. The first session, which I'm going to moderate, is on climate change and municipal finance. We've got 3 papers. The way that we do there will be a certain amount of getting up and getting down. So we don't want to block the slides. So when somebody is presenting, only the presenter will be up here. Then for the Q&A, the presenter, the discussant, and I, as kind of the referee or ringleader, what have you, will sort of be up on the stage, and then we'll go on to the next paper. We've got 3 great papers in this part of the program. The first paper is Physical Climate Risk Priced? Evidence from regional variation and exposure to heat stress. Tim Johnson of the University of Illinois is going to present that. And we've got Tom Doe, the founder of Municipal Market Analytics, who will be the discussant. And then we will transition, we will get off the stage and then we'll go directly to the second paper we're very excited about. It's the Emerging Greenium Baolian Wang of the University of Florida will present that paper, and the discussant will be Monica Reed, the founder and CEO of Kestrel. Then we will get down again, and we'll have the third paper of the session, natural disasters and municipal bonds. It's kind of, as we think about all of the stuff going on recently in the Northeast, elsewhere with natural disasters, we thought we'd start with this on the program. The presenter of that is Jun Kyung All of Yonsei University, who will present that paper, and then Ivan Ivanov of the Federal Reserve Bank of Chicago will be the discussant. So I will come back when it's time to moderate the discussion between the author and the discussant. But with that, I'm going to turn it over to Tim Johnson of the University of Illinois.
Okay, thank you to the conference organizers for having this paper, and thanks, Dan. As you can see, the title of the paper is this paper is going to look at physical climate risk, and it's going to be looking at actually 3 different asset classes, namely municipal bonds, corporate bonds, and equities. In the interest of this audience, I'm going to focus on the municipal bond results. The equity results, besides just verifying the municipal findings, they're interesting for some other reasons in terms of getting at effects coming from cash flows versus discount rates, but it's in the paper. So we'll leave that out for today. The other thing to point out is that we're going to be focusing on heat stress in this paper. Now, a development in climate finance and, climate economics in general is that recently researchers have started to decompose potential, potential damages due to various aspects of climate change into their components, things like hurricanes, sea level rise, floods, wildfires, and direct effects of heat stress. Of course, all of these may be viewed as indirect effects of heat stress, but researchers have actually broken them down into, direct versus these other things. And so that's one of the things we're going to do in this paper is we're going to look at specifically the direct effects of heat exposure, and that turns out to matter. It turns out that if you lump everything together, for example, you don't get the same results that you do if you disaggregate and look just at heat stress. So I know I don't need to work too hard to motivate a paper about the seriousness of heat stress at a conference in July in the district, but what ends up happening is that in terms of economic magnitudes, heat stress is a lot bigger in aggregate than the effects that are anticipated from, let's say, hurricanes. Why is that? Well, hurricanes are more localized, but to some degree there's also the possibilities that, that there's more mitigation measures available. Heat stress is very hard to mitigate against, as you all know, especially if you work outdoors, for example, right? Or if you are directly dependent on energy expenditures, right? And those things are broken down into some different components there. And this is not from us. This is just from another paper in the literature that we're going to build on. And as I said, it's just kind of shockingly easy to come up with news stories emphasizing the significant nature of heat waves and their effect on their possible economic effects. I could have just made these slides just from today's headlines, but these are from last winter. Did you know that nuclear plants are threatened by heat stress? That's a scary one, right? I didn't even know that, but I'll skip with the examples here and just give you a brief preview of the results. So our question is physical climate risk priced? And heat stress does increase municipal and corporate bond spreads and conditional expected returns on equity. So that's sort of lumping all the 3 together. Just to focus on munis, again, we get about a 15 basis point effect in credit spreads particularly for long-term bonds for, let's say, a county whose GDP is expected to be impacted by 1% per year. And I'll be more precise about what those measurements are in a moment. The other ones, well, I'll skip number 2. What we can do because of other researchers breaking down the different components of climate risk is we can actually look at the other ones in aggregate, the hurricane, the sea level risk and stuff, and I'll show you if I have time, we get nothing. Okay, so that's not to say it's not there, but certainly our empirical methods are not picking it up. So just leave it at that. So just graphically, what we're finding is actually a time series effect that somewhere around 2010, 2011, these effects went from negligible in the cross-section to significant, and these are basis points for one of our measures in the horizontal axis for kind of a 1 standard deviation exposed municipality, or I should say county, Actually, the data is on the issuer level, right? So the issuer month level. So what we have is we have these heat stress measures at the county level, and then we can say, okay, we can locate municipal issuers to within a county, which, you can do with census data. When we do the same things with corporates, it's a little more complicated, but again, I'm not going to talk about that today. These are the ones for corporates. And I'll skip over that. So let me get into the measurement. There's two main measurement strategies in the paper. One comes from the so-called Sea-Glass study that was published in Science by Chang et al. In this case, it's about 15 authors. It's an extensive study based on, if those of you in the climate sphere know RCP well, there's all these climate models out there. They make projections under different scenarios about global policy responses. So the one that we call RCP 8.5 is one of these, not necessarily the worst case scenario, but it's a pretty bad case scenario. And then given that scenario, there's like 44 different climate models run to give you a range of possible outcomes, again, at the county level. So what Chang et al. Did is they translated this into measures of lost productivity, increased energy expenses. We take it a step further and say, okay, well, can we then aggregate, can we put that in terms of money terms, in terms of GDP based on county level or state level expenditures on labor, different types of labor, and on energy expenses? So we do a little bit more just to translate the number into a fraction of county level GDP. We also, another thing we do is we take a step back and say, look, if we don't want to overlay all these economic assumptions, can we just look at the projected number of hot days? So we have we do a bunch of robustness tests where, again, at the county level, we take all these forecasts and we say, under this RCP 8.5 scenario, how many days over 100 degrees Fahrenheit will there be in 2080 or the end of the century versus baseline 2012? So that's, in the paper, that's called delta hot days. And we just do that in case you're worried about any of the economic assumptions that get overlaid on the basic climate assumptions that come from the Sea-Glass projections. So let's say, so there are definitely some limitations to this. Let me just go to those. So this measures actually only look at economic activity declines through labor productivity and energy expenditures. They don't include, for example, direct damages to infrastructure, which obviously going to affect economic growth. They don't affect, for example, energy output, right? Energy transmission and output are both negatively affected by heat days as well. And they actually don't even include direct effects on human health. So those are some pretty big omissions. We might suggest they understate. On the other hand, they don't do a great job of factoring in sophisticated measures of mitigation at the county level of various activities that might be undertaken. So overestimate, underestimate, yeah, these are well-documented problems with this methodology in the literature. So we don't have very much to do about that, except that, as I said, we do undo the economic projections and just fall back on the climate projections for a bunch of robustness tests. So the next thing we do is we say, okay, so this is just a picture of these climate projections and how we get delta hot days. I think I can skip that one. Okay, I just said that enough. Okay, this other measure we have is from this company called 427 that got bought by Moody's in 2020. What they do is, and this is principally for corporates, because they do it at the corporate level. They figure out, based on the physical location of all of a corporation's, enterprises, what their exposures are, and then aggregate them up. So that enables us to, make some mileage in the second part of the paper. But they do it for municipalities as well. And so, their methodology is a black box. It's proprietary. So we can't tell you exactly what they do and what they don't do. They assign every municipality's score on a scale of 0 to 100. So what does that mean? What's the difference between a 50 and a 20? I don't know. I can't tell you. So all we can do is use that as it is. It's, it is an independent methodology, so it's good for robustness tests. And of course, the other thing that they provide is they do a breakdown of hurricane risk, wildfire risk, flood risk, and direct heat risk as well. So which the Sea-Glass effect did not do. So that's another reason to use it. I will say about both these methodologies that they do suffer some limitations. For one thing, they are each just snapshots. We only have them once in time. So to the extent that counties' exposure is being changed, for example, through mitigation investment, which we hope some of that's going on. But anyway, we don't know. And then these measures aren't going to pick that up. I don't remember the exact timing, but I think the 427 measure was something like 2019, and the Sea-Glass was something like 2012. Okay, so each of those is just there's no time series variation. Those measures just a straight cross-county snapshot. Summary statistics for the risk measures. Do I care about those? No, I mean, yes, of course I care, but in the interest of time. Let's see, anything else I wanted to say about that? No, I think I'll skip that. Okay, so let's get into identification. Oh, damn, sorry, 5 minutes. Woo! Okay, skip identification. Basically, we're going to do 2 specifications. One is a regression specification with a lot of fixed effects. Okay, so the main fixed effects that we're going to be using are are rating by industry buckets. Okay, so to the extent that there are things that we need to control for at the county level, we're really kind of hoping that the rating agencies do a good job of picking this up. If they don't, we're also going to have county fixed effects, which means that anything that varies across counties that we might want to measure, political affiliation or, I don't know, or just latitude, right? Just location, right? Those in principle should be picked up by the county fixed effects. So first methodology is going to be a regression methodology with the main independent variable being heat stress by year. Okay, so you saw that graph I showed you before with different coefficients for each year. Those are just the coefficients from the regression. So that's the first methodology. The second methodology is matching, and that was based on the suggestions from the paper of my colleagues who are going to present third in the session. And basically what we're doing there is we're taking each bond issuer, and if they're in the top 20% of exposed counties, matching them with a similar bond in the same month, in the same rating bucket from a county that's in the lower 50% of the exposure, then rerunning those regressions. Okay, so main results. Well, as we saw from the picture, we've got the heat damages. That's the one from the sea glass measure. And then we've got the heat score, which is the one from the 427 measure. We see a pattern of significant coefficients starting to emerge around 2012. We don't have strong priors or opinions about what happened in 2012 or what happened around then. You know, we can show you various anecdotal evidence about, more concern with climate change from surveys and things like that. We can show you that more bad climate news came out around then, but we don't have any hard evidence to pin down like what really is driving the time trend in this. Okay, but the time trend is an important message that I definitely want to see as one of the takeaways from this paper. I want to skip to the matching results. Okay, so we match on different things, right? Coupon, time to maturity, and so on, and then county variables, and then we do the same regressions. Strikingly similar patterns. I don't have really time to talk about it. The coefficients are a little bit bigger, but that's because the first quintile versus bottom quintile is a little bit bigger spread in the independent variable, so it's not really inconsistent, and the pattern in coefficients is really strikingly consistent. Okay, so mechanisms. We have subsamples where we break it down into long-term, short-term bonds, bonds with low credit rating or high credit rating. I guess I do have time to just quickly look at those. Ratings, well, as you might expect, we're getting almost nothing from high-rated municipalities. These are long-term effects. I should show you the long-term ones probably first, because you might very well say, look, these climate risks, if they manifest in county-level cash flows, it's going to take a while, right? I mean, short-term credit's not going to be affected, and that's exactly what this paper shows. And in fact, this paper shows that in terms of the long-term bonds, the time series pattern is not really as robust as I said it was, right? It starts even as far back as 2008, we were getting positive coefficients. So it's more that the aggregate, when you put the short-term and long-term together, that you don't really start to see anything until 2012. So that tells us that, okay, so it's not necessarily, we don't have to think of 2012 as a magic number. In terms of when things started. Again, in ratings, and this parallels what we're going to find in corporates, which I'm not going to have time to talk about, that it shows up in low-grade credits, not high-grade credits. And in terms of revenue versus geo, it shows up in revenue bonds, not general obligation bonds. Again, revenues, if they're directly impacted, they can't fall back on the general tax base, and so maybe that accords with intuition as well. Let me just briefly show you the fact that other physical risks, okay? So the caveats here, we may not have a lot of power to detect the other physical risks because, for example, like sea rise risk is limited to a small number of counties, right? So when you put them in the giant cross-section with all the counties in the United States, it's a relatively small number of counties that's available, that's affected, even though for them it's quite bad, we're just not seeing. Can you see that? Sea level, hurricane score, rainfall score, water score, and heat score. Well, the heat score is the one we're pointing to. The other ones are a bunch of zeros. Okay? So, again, we don't want to say that they don't matter, but it's certainly harder to detect. And this shows you that a takeaway from this paper is it is important to disaggregate direct effects of the different types of perils that climate risk poses. So let me conclude in my last minute 19, because I think there are some important takeaways from the paper. Heat stress seems to be a systematically priced source of risk across different asset classes. Again, we have robust results from the corporate bonds and the equity expected returns. Positive premiums suggest climate change has significant negative impact on the aggregate economy, and there's, of course, implications for the discount rates used for the climate abatement investment, and how risk exposure is measured is important. What I would say is my personal takeaway from this paper is that it's getting worse in terms of the price that you're going to have to pay if you're in an affected county. The mitigation costs, the capital costs, you are only going to go up from here. Of course, this is my speculation. This is not supported by the data, but it looks like the time trend is going in the wrong direction. So, of course, these are the counties that should be investing in mitigation measures, right? So this is actually an important lesson. Do it now. Okay, do it now, because it's not going to get any easier. Okay, thank you.
Well, good morning, everyone. Can you hear me all right? Yes? Good, great. It's a pleasure to be here, and of course, this is a really important topic. We're all become incredibly sensitized to it. And I think these types of papers that are coming out in studies are just incredibly important. I'm a big believer that the municipal industry has a great opportunity ahead. Adaptation projects are going to become a big part of the industry. It's going to be a revenue opportunity from the banking side, because how are we going to finance the ways of protecting and stabilizing infrastructure going forward? When I've had the opportunity to work with the Center of Municipal Finance at University of Chicago, we had a climate conference last November out there, and what was exciting about that was the new generation of people that are students that are gravitating toward the municipal industry and public policy around the climate issue. So from that standpoint, very, very excited. And so thank you for Brookings and the 4 academic institutions for hosting this conference. So when I was reading this paper, and the first time I was like, wow, this is like contrary to anything I see on a daily basis in the market. I don't see it priced in to securities. And so I was reading it with great interest as to, well, where's the disconnect from what I'm observing and from what the study presented. And I started to focus on the credit spread element, which was widened in 2010 to 2013, which is where we're seeing the big difference. Well, a key thing that was going on there is that, right, the municipal and bond insurers were, many bonds that were insured had lower credit ratings, all of a sudden started trading to their underlying credit as opposed to being AAA. So you had a tight spread compression in 08, 09, 10, and then when the credits lost their AAA because of insurance, the spreads widened out dramatically. And you can see that specifically by just using generic credit measures of bond buyer index, for example, kind of an antiquated piece of data set, but nonetheless it compares general obligation to revenue to give you that kind of picture, and there you see the widening. Now the widening is kind of stabilized as Tim's graph showed over the last few years, and during this time, also in 2013, we had not only the taper tantrum from the Fed, but we also had the municipal industry adjusting to the problems in Puerto Rico. And we had mutual funds that were starting to divest or to sell, reduce their exposure to the Puerto Rico credit. And that created a lot of turbulence in the marketplace as well. And that may have also had some impact on credits. Now, also during the low interest rate period, we also had a period where instead of having the municipal industry went from being par coupon structure through about 2005 and then shifted to a 5% coupon. And then during the low rate environment, we had a lot of longer maturities, had 2 and 3% coupon structure, and then now we've come back to 5. Well, what that's in fact doing is creating a lot of volatility in the longer maturities so there may be some structural volatility that may also be contributing to some of the discord in the data. The other thing I struggled with, Tim, was that is that your choice of using bonds and using trade data that was after the 2 or 3 months after original issuance. Because we know that bonds after they're originally issued, one is they do break to lower yields. We know that. That's just the underwriting process that's in the municipal industry. But we also know that that's the most active time of trading. So as my colleague Matt Fabian likes to talk about, is that when we're talking about the municipal market, we're really comparing it to a flea market. I mean, that's really what the muni market is, of this inconsistent over-the-counter negotiate, what something's worth. And so the less less trading, less activity, less price discovery, all of a sudden these trades that you were utilizing as there was less trading, I just kind of felt like maybe there were some inconsistencies that were maybe showing up in the data, especially when you're kind of in the lower rated parts of the market. So, but what I think I get excited about all this stuff because I think it's critically important, and the more attention to the municipal market and the climate crisis that's before us is that we need to understand the data that we're utilizing, not just within the municipal market itself, but also the climate data and the various the sources of it. And so now when I was very involved with the people at risk who are now owned by ICE for the last 5 years, you mentioned 427, which is some of the use of your data, and we have, FEMA is now out there. We have new free sources. We have third-party commercial sources of data, and trying to discern what's the best data. And I think the problem we're going to run into going forward is that as municipalities and states and others start to address this problem and start planning and designing projects, is going to be what data do we use? And what I'm biggest concerned is by spending a lot of time trying to discern what data is best, we're going to burn time off the clock, and we're not going to be taking action that's so critically important. The other point that you made that I think I was pleased to see is that the rating agencies you don't see the credit changes as in response to climate risk. I think it's fair to say that there's been no credit downgrade that's attributed to climate issues that's occurred yet in the industry. And certainly heat, I think, is only in the last couple of years, I think, has become a condition of sensitivity in the marketplace. And I think this is a broader issue that I think requires some examination, which is ratings are a 2 to 3 year outlook. We're looking at risks that will have impact over the next 10 to 30 years. What does that mean to the investor? And I think that the problem that we have looking historically is that individual investors, which are a bigger and bigger part of our marketplace, always a big holder, but now there's more direct investment. Separate managed accounts have gone from $500 billion to nearly $1 trillion now. The mutual fund complex is now eroding. We have more direct involvement, so there could be more direct sensitivity to this issue and how it's reflected, how it's communicated by the rating agencies. And my concern with the rating side is that the individual looks at the rating as not being a risk of default over this 2 to 3 year period, but it's an assessment of whatever security they're buying. They're just ignorant to or naive might be a better word, to those long-term, what the rating is communicating. And so that communication of risk is a failure within our industry right now, and I think that's what the data was suggesting, is that that's an issue. And I look at how the insurance industry has shifted from looking back using historical data to now looking at model data and looking at some of the climate data that's out there now, as I say, all these different providers that give us a forward-looking. And that's what the insurance industry has pivoted that way. The municipal industry needs to do that as well. And so papers like this, I think, are, despite the comments I've made about some have the municipal data, which is quirky and hard to deal with and messy, and it's not like equities and corporates, and that's a challenge. But I think those are I think it's to be applauded that we're starting to take these steps toward investigation and the exposure or the understanding that these risks are out there, but they're not, I think, fully priced in. And the risk guys and Breckenridge, a large separate managed account, has 40 to 60 billion in municipals under management. They both have done studies in 2021 and 2022. In fact, Breckenridge's paper was presented last year at this conference and found that municipals weren't pricing in climate risk. So again, I think, and I didn't see that in the appendix of papers that were cited. So I guess there's just more data to take a look at and to continue kind of to explore. So, excited about the paper, glad it was presented. There's just more work to be done with a messy data set called the municipal market. Thank you.
So I'm going to arrange this up here. So Tim, yeah, you're there. First thing I want to do. Can you hear me okay? I'm speaking in the microphone. There you go. All right. Can you hear me now? Is that better? So that when it's red, you're audible. So the first thing I want to do, I want to give Tim the opportunity to respond to Tom's comments. So Tim, do you have a...
Sure. Yeah. Let me just start with the rating agency at the end, because I didn't have time to talk about it, but we are actually using as part of our econometric strategy the fact that the rating agencies did not historically reflect climate risk, right? Because we're using that as an important control. And if they had been taking into account climate change and climate risks all along during the sample period, they'd absorb the effect we're looking for. So that's actually something that's oddly working in our favor. Now, the rating agencies have all put out white papers in the last couple of years talking about how they're now going to take it seriously. But at the same time, as Tom points out, they're saying, well, look, to the extent that these cash flows are going to happen in 20, 30, 40 years, we're not really going to be making very many rating adjustments. And there have been only a handful of rating adjustments based on climate that I know of. So that agrees with Tom's observation. In terms of looking at the throwing out the first 2 or 3 months of trading data, I also have trouble with that. And here I just have to take the cheap way out, which is to say we're following the literature. There's 2 or 3 other well-cited papers in finance that do this, explain why they do it, and we don't want to get those guys as referees and said you do something non-standard, right? So that's part of the game. But I mean, that doesn't mean that we couldn't redo the tests with that earlier data and just see what happens, right? So that's a great comment. I want to learn more from Tom, and we'll follow up afterwards about what really happened with insurance providers in the 2010-2012 period, because that's a kind of a gap in my own knowledge. In terms of, likewise in terms of what was going on in terms of the coupon choices. I will just point out that in our matching sample, which I didn't have time to go over in detail, we do match on coupon, right? So there we are comparing only 2% coupons to 2% coupons and 5% to 5%. No, I have to also get from Tom afterwards the reference to the Breckenridge and the risk papers, because those are missing from our sites. So thanks, Tom.
Great. So I want to turn it to the audience to ask questions. So one thing that I'll say, we've got folks running around with microphones. Before you ask your question, just let us know who you are. Even if I know who you are. Yeah, I know who you are, Dan. But yeah, when you ask the question, say, I'm Dan Garrett, and here's my question.
I'll try to start us off okay. I'm Dan Garrett from the Wharton School. I have a question. So you ended the talk, this is for Tim, with a quote saying, it's getting worse, capital costs are only going up, but that really isn't reflected in the estimates that you showed us. So instead, it does look like a really peak in 2016 and they're coming down. So I thought of kind of 3 examples of what could be happening, which is 1, as the costs go up, counties could be changing what sort of projects they're investing in. So as you face a relatively higher credit spread, you can change the nature of your investments, and that could be showing up. The second is that, of course, the credit rating agencies could be taking this into account, the credit rating controls that you're using. So I'm wondering if maybe dropping those from the regressions could be a way of showing kind of what the long-run impact is happening. And also it could be that the places that are impacted in 2012 actually adopt. And so they do kind of take these adaptation sort of behaviors. And so I'm wondering if you can say something about that using the 2019 snapshot of risks that you all use as well.
Thanks, Dan. Yep, those are great comments, and I will just repeat that was me speculating at the end. It was not supported by econometric evidence. It seems to me like I don't know. I guess it's just influenced by just picking up the paper every day this summer. It's, oh my God, it's, it's Vermont, it's Philadelphia, it's all of Italy, but no, I agree. I don't see a lot of evidence of adaptation investment going on. I agree, it could be going on, and it's just a small effect, but credit markets are sensitive to it, and I, as a naive observer, am not. In terms of the rating agencies taking into account, that's absolutely right. That would give exactly the effect. That would cause things to plateau out.
Just two quick comments to that. One is, in talking with sustainability officers, it is amazing to me. One, they have no knowledge of the capital markets, limited knowledge in terms of funding. They're always looking for grants, right? They're not looking to the marketplace, don't even understand it. And then they go, well, as long as our rating doesn't change, then I guess we're okay. So the ratings agencies, again, have this incredible power and influence that, because of the way it's been structured historically, is that I don't think they're doing I'll just leave it there. But the other thing, we're encouraging, because we don't see it being priced we don't see climate risk being priced into the marketplace and by QSIP and all. Anyway, we're encouraging issuers to come to market now, to Tim's final point, which was you're not being penalized. If you need to have to protect your infrastructure, you should do so ASAP. And there are banking entities that are now hearing that message and engaging their clients to have those discussions.
I see Mark Funkhauser over here.
Just a quick comment about the whole relationship between municipal governments and the rating agencies. It's astonishing to me that they make that argument that, well, we haven't seen the rating change. Mark Funkhauser, Funkhauser and Associates. When I was in Kansas City, I would hear that argument from officials, and I'd say, waiting for the rating change is like waiting till your car hits a tree to tap the brakes. I mean, it's just as strange to me that we haven't explained to local government officials yet what it means. The rating happens after bad stuff happens.
Thank you. Micah Green with the law firm Steptoe & Johnson. This is all fascinating, and you talk about mitigation. Obviously, a single locality or a county or even a state can mitigate, the climate of the globe. At this point, it takes the whole world to be willing to do that. But there's also mitigation. You could raise the dunes on the beach to avoid flooding. You could do other things in constructing evidence. But also, one of the mitigation efforts, and really, how do you reflect this in these studies, is that if there is a problem, it may be called a natural disaster, but a forest fire or flood or drought or whatever, which is caused by climate, ultimately has FEMA or the federal government coming in a big-time way with funding, as we saw in Puerto Rico, California, Texas, and Florida, and Louisiana. How does that get factored in? Because if the risks are there, but they're ultimately covered by the federal government, how does that get factored into the credit exposure?
Well, I think one of the unique things about heat waves is that it's very hard to write a contract on a heat wave. So there's very little insurance or mitigation efforts that can be the subject of a grant, for example, that you can say, well, okay, here is exactly the covered peril. That's just not the way insurers think about it, right? You can write a grant about hurricane damage. I mean, you can write a policy on hurricane damage. You can write a policy on flood damage. But we see very little. In fact, the state of California has commissioned some explicit studies of how can we help the insurance industry develop products that specifically, fit in with their rubric of things that they cover, but it hasn't happened yet. And I think this may be one of the reasons why, markets are more concerned with heat stress than with some of these other perils that we have trouble picking up effects for. I don't know if that addresses your question, but I think it's an important aspect of what makes heat different.
And Micah, remember that the municipal market has loved climate events and disasters, right? It's always hurricane comes in, knocks everything down, everyone gets nervous about it, what it's going to mean about the credit, and then there's a rebuilding process that's funded by the federal government, the credit rebounds, performance occurs, and everybody's happy again, and we go the cycle over and over. And of course, FEMA's changing. right? FEMA is now saying, look, you have infrastructure at risk. You now have data that can identify that risk. And if you're not doing adaptation and resilience type of projects, then guess what? We might not be there. And I think one of the great examples of thinking forward is what's happened at Battery Park with their efforts to protect the citizens that live there in that community. About, I think it's 26,000 or something like this. But as they went to the capital markets, almost had a $1 billion issue for their project. It almost took a decade to put the whole thing together. But they talked to FEMA while they were doing that, so that if problems did occur, is that FEMA would be there to support them.
Okay, this has been fantastic. We now have to transition to we now get to transition to the second paper in the session. So join me in thanking Tom and Tim. We are all going to sit down, and Professor Wang from the University of Florida will come and present the paper, The Emerging Greenium, and the discussant will be Monica Reed, the founder and CEO of Kestrel.
Is it better now? Okay. Okay. First of all, I want to thank the conference organizer for putting this paper on the program. Thank them for moderating. I look forward to Monica's discussion later on. So the title of the paper is Emerging Greenium. We study this question using data from the municipal bond market. This is my first time looking into municipal bond market. First time studying ESG related issues. I know very little about both sides. So I'm very nervous when I'm presenting in front of 200 people, maybe another 300 online. Okay. Luckily, it's a very simple paper. Hopefully, it's convincing. Very fundamental question. So the motivation of the paper is, are investors willing to pay a higher price for ESG investment relative to non-ESG investment? I'm using terms a little bit. E here in this paper is basically, ESG basically we only look at E part, not S, not G. So the answer to this question is at the core of the discussion of how the financial market can contribute to dealing with ESG related issues. So one very important argument is that if we get a lot of investors who are interested in ESG and they are willing to pay, and they will lower the cost of capital of green assets versus brown assets. The cost of capital of green assets will be lower, and there will be more green investment. So that's the argument. So this is basically ESG. It's the whole area. My opinion is there's a lot of eternality, but when we talk about financial market, we want a private investment, private party to solve a social problem. Okay, but there may be hope. Before I talk about data, very little theory. This is my opinion, so no doubt that most people have ESG preference. Do you like better environment? Of course, okay. But no doubt that some people who are willing to pay, okay. I'm not saying that everyone is willing to pay. Whenever I do a survey, at least 15-20% of my students tend to say, okay, I'm willing to pay maybe 10 basis points or 15 basis points. And 80% or 90%, they are unwilling to pay. But we do know that some people are willing to pay. Okay. Does this translate to asset pricing impact directly since some people are willing to pay? The argument is that if some people are willing to pay, others are unwilling to pay, and you are paying to increase the price of green assets, then other investors without such a preference, they will switch to other assets. In equilibrium, there may not be a big impact. That's very basic asset pricing theory. In my opinion, it is a very standard free rider problem. Okay, you are doing something I like, please do. Okay, I'm going away, enjoy my private benefit. Okay, so the theoretical prediction is actually very unclear. What is greenium? Greenium or green premium is the amount of by which the yield on a green bond is lower than the otherwise identical conventional bond. So think about the difference between green bond versus a conventional bond. The only difference is the use of proceeds. The green bond are supposed, the proceeds of green bond is supposed to be used for environmentally friendly project. Everything else should be the same. Okay. There may be a yield difference. If there's a yield difference, we call that greenium or green premium. Okay. I think if we see a positive greenium, the yield on green bond is lower than otherwise identical non-green bond, then that's very clear evidence that investors are willing to pay. Okay, the question is whether they are willing to pay, and if they are willing to pay, and by how much. The municipal bond market is very special, unique for this purpose. And as this audience, probably most of you are aware, the municipal bond issuer, they actually issue many municipal bonds at the same time. So I'm showing you one example. On the left-hand side, those are green bonds. On the right-hand side, those are conventional bonds. You see around 15 green bonds and maybe 13 conventional bonds with various maturities. Okay, and there are cases that green bond and non-green bond, they have almost identical structure. The only difference is one is green, the other is non-green. And the one I highlight, both of them with maturity in 2033 and identical maturity the same issuance day because they were all issued at the same day in the same deal. In most of the cases, so this is by design the same issuer, the same issuance day, the same maturity, almost always the same credit risk, any important characteristic differences between those bonds you can think of, they are almost always identical. Okay, the only difference is the issuance amount may differ a little bit, and one is green, the other is non-green. So you get that label. Okay. So we do exact match. So the same issuer, the same issuance day, same maturity day, same credit rating, same call date. Some of the bonds are callable. And we also match based on source of payment. It's a revenue bond or GO bond, and 80% of the bonds are GO bonds. The results are very similar, even just focus on the GO bonds. Not federal taxable. And roughly 80% of them actually have the same coupon rate. Okay, when we look at greenium, I'm going to tell you we get a greenium roughly 2 to 3 basis points. When the magnitude is not that large, if you get a two bond that differ in coupon rate, and that difference in coupon may actually lead to a difference in yield that's as large as 2 or 3 basis points. So it's very good that in this setting, almost all the bonds, 80% plus of the bonds, they have identical coupon rate. So even if you worry about a term structure that's not flat, then that's not even a concern here. So our sample started in 2013 and in roughly March 2022, that's when we got the data, we got roughly 1,000 exact match pairs. Roughly 690 before 2018 and 340 after 2018. You may wonder why I have that time split, because there's no greenium before that and there's a greenium after. Okay. I'm showing you the results by the two different sample periods. This is a cumulative distribution function. That's the green bond yield minus the yield of the exact match. Remember, they're almost identical. One is green, the other is non-green. The blue curve is before 2018. The red one is after 2018. You start to see that after 2018, there are about 20% of the cases, there is a greenium. So yield of green bond lower. There are very small number of that it goes the other way. Okay, but before 2018, basically, it's 10% above, 10% below, but now it's 20% below zero. Another interesting finding is underwriter discount. This is basically the commission charged by the underwriters. You'll see that before 2018, underwriters that charge more if you issue a green bond, but now they charge less. Okay, it's about 4 basis points lower. Okay. It's probably easier to market a green bond now than a few years ago. If you put them together, that's roughly, in total, roughly 4 basis points. Of course, the underwriter discount, you should adjust that with the modified duration, so put them in the same, make them comparable. Okay. The emerging green, as we call that in the title of the paper, this is coincide with the increase in the attention or recognition of ESG. Okay, you see that this is the Google trend. The blue line shows ESG. The other two were different terms used very similar setting. There's no trend for other terms, but ESG you see a quick increase. If you put them together, you see a similar trend in 2018, 2019. I'm not claiming any causal relationship, but you see this trend, the correlation. Okay, a summary, the headline numbers, post-2018, green is about roughly 2.3 basis points. Yield of this or sample municipal bond roughly 200 basis points. The credit spread relative to treasury, that's roughly 20 basis points. So you can form your own opinion whether 2.3 is large enough. Okay, underwriter discount difference about 3.9 basis points. And on average, underwriter discount in our sample was around 50 basis points. Total issuance cost, say, if you issue a green bond, that's roughly 4 basis points. Okay, that's my main finding. The next finding is look into the cross-section. Since I'm going to focus on the post-2018 sample because before that we don't really see any interesting cross-sectional variation. One interesting variation we are going to focus, I'm going to talk about two. The first one is the use of proceeds. There are actually green bonds and their exact matches. If you look at the prospectus, you see, okay, both bonds are going to fund the same project. Okay, green bond and non-green bond used for the same project, of course, slightly different part of the building. One example is you see the second one, Dormitory Authority of State New York, Columbia University Revenue Bond Series 2016. The green bond, 2016 A1, is used toward the construction of the Jerome Green Science Center. If you read the second one, it's the same center, the same building, but the first one, I'm going to use that for some kind of green certification. The second one is the Romanian. Okay. My co-authors and I read all the prospectus, we figure out cases like this. We think the Columbia University one, we think that's the user proceeds is the same. Even though one is green, the other one is not. Don't forget that money is fungible. Okay, it's very simple. Money is fungible. But there are many cases that the green bond and non-green bond used for different projects. The University of Cincinnati case are used for two completely different buildings. Okay. Many cases, one is for higher education, the other one maybe for utility, completely different purposes. Okay. Guys, where you see green? Yeah. You only see green when the user proceeds are different. If the user proceeds is identical for the second example here, the Columbia University one, you don't see any green, it's almost always exactly zero. Underwriter discount, you see very similar pattern. So that's roughly half a sample is same user proceeds, half a sample different uses. And since in the same user proceeds sample, you don't see any green conditional on the uses are different, the magnitude double. Okay. I think that's intuitive. The last finding is the term structure of green. Since we have exact matches, we can look into the term structure. And we see a downward slope term structure. So for the green bonds with maturity less than 5 years, green is about 5 basis points. Between 5 and 10, that's slightly lower than 2 basis points. And 10 to 15, 15 to 20 is similar, but 20 years, we don't see any green yet. Okay, we don't have this type of pattern for underwriter discount. Underwriter discount is basically flat with respect to maturity. Okay. It's hard to find the interpretation, but one speculation I have is there may be some kind of liquidity premium. I want to invest into ESG. I'm a good person, but I don't want to commit for too long. Okay. But that's my speculation. So, okay. Let me conclude. So the headline finding of this paper is the average premium 2.3 basis point post 2018, but before that it's exactly 0. But one thing I haven't mentioned is even after 2018, majority cases the premium exactly 0. It's just in small number of them you see premium. Okay. So on average, investors are willing to pay, but in most cases they are not paying. Okay, but conditional on they're willing to pay, the magnitude is probably significantly higher than 2.3 basis point. It also says that if you can structure deal sometimes, you can structure deal to make the green bond a non-green bond for different purposes to mitigate any kind of greenwashing concern. Maybe investors are more willing to pay. Okay. Okay, let me stop here. I look forward to Monica's discussion.
Perfect, thanks. Will do. Hi. Thank you very much for inviting me here today. I'm really happy to be here. It's my first experience with Brookings, and it's really been a pleasure to meet folks already, and I've learned a lot through this process. I'm Monica Reed. I'm the CEO and founder of Kestrel. So I've organized my remarks in a few ways. I just want to introduce my company and the role that we play in the U.S. municipal market. We're a new entrant into the market. I want to talk a little bit about some of the factors that are related to greenness that might also be influencing results that the University of Florida team found. I also wanted to talk a little bit about the additional value that investors might also be receiving with green bonds other than the greenium, and a few thoughts on the future of green bonds. And my message that I want to impart to you about green bonds is that the story is not so much about greenness as it is about investment in risk mitigation. So first, just a little bit about Kestrel. Kestrel is the market leader for green, social, and sustainability bond verification in the U.S. municipal market. We have about 82% of the market share last quarter. So we are talking to a lot of people, a lot of issuers, a lot of deal teams, and a lot of investors about green, social, and sustainability bonds. And our mission has been to try to bring some standardization to the process of issuing green bonds and help create more efficiency in the green bond market. Prior to us entering the market in 2018, it really was a wild west. So there's been a standardization. So we provide these, our reports are called second party opinions. We also do a climate bonds certifications, another sort of form of green bond. We do reporting on those things. And we also have an ESG data product on municipal bonds. We score the primary market every day, and I'll tell you a little bit about that. So our second party opinions, it's 46% of the total market, about 82% when you have a second party opinion involved. So that's a big distinction in green bonds in the U.S. municipal market, whether the green bond is self-verified or whether they've hired an assurance provider like Kestrel or Sustainalytics to go and provide an independent external review and comments on on the greenness. We've done over 200 second-party opinions, mostly in the municipal market. We've worked in 29 states, in Europe and in Canada. And we're known for our technical rigor. All of our analysts are environmental scientists or social scientists. They're not finance people, so this is really different than a credit rating. This is really talking about the risk mitigants and the sustainability that is inherent in the financed activities. So some other factors related to greenness that might possibly be contributing to the results. The first, as I mentioned, prior to 2018, it really was the Wild West. Everybody was saying there is no standard for green. There are no standards. And you had issuers that would make up their own standard for what was going to be a green bond. You had some issuers who would not mention any standard at all and just say this is a green bond. We'd have issuers who would say this is a green bond as per the green bond principles, which is one international voluntary standard. And then you had a few that would do a green bond as per the climate bond standard, which is one of the most robust green bond standards in the world. And so there was that whole spectrum, but in the muni market, it was really tilted toward there are no standards. And since 2018, there's been this progressive increase in second-party opinions, in coalescing. Things are really coalescing. Green bonds are green as per the green bond principles or the climate bond standard. Generally, that's where most of them are. There's also, as I mentioned, this rise of external reviews. And 2022 was the first year that we had, in 2 quarters, the green bonds issued with second-party opinions outnumbered the self-verified ones. So I like to think that's my team out there doing the outreach to try to do that. But it's great because it creates efficiency in the market. So what other things do investors receive if they are indeed paying the greenium, which I'm really excited to hear those results. Well, the first is risk mitigation. So people are talking about risk mitigation already, right? So the green bonds are financing these green assets, and the green assets incorporate the resilience that helps mitigate against the backdrop of climate change. Investors also receive some greater transparency. Investors are clamoring for transparency. They want to know what's happening. So having this external assurance on the green bond it's increased information. And even if there isn't a second-party opinion on the bond, more and more green bonds have a new section of the official statement where they're talking more about the green financed assets and the resilience and sustainability incorporated in those assets. There's a new world of compliance for investors, and the second-party opinion on the green bond helps to satisfy some internal and external compliance mandates for investors. So that's another thing. It can get, if it's a green bond and it has a second-party opinion on it, it can kind of get through the review process more easily. Saves them a little bit of time, gives them a little bit of cover in a world of increasing regulation. And lastly, of course, it helps them meet consumer demand for climate-aligned investment products. So green bond is an easy slam dunk on that. So what value do issuers get by issuing green bonds? Because the greenium is not something we talk about a lot. We don't, in Kestrel, we go around, we're trying to talk with issuers and their deal teams about issuing green bonds. We are not promising a greenium at all. We don't even talk about it. But we do have 5 cases of twin bonds where we've worked on the deal, and the issuer, same day, same coupon, green, not green. And we have 5 cases where there's been a 1 to 5 basis point greenium that we've seen in our work. But we debrief with every job. We debrief with every client to learn how the story ends. How did the sale go? And we also want to know about the process too. And we always ask investors what happened. And the vast majority say they had oversubscription, they had new investors to the credit, they had new ESG investors, And the ESG investors stayed in through the repricing. They were really sticky. So it allowed them to do the repricing. They also, municipal issuers, municipal government is so complicated, they are moving on multiple fronts at the same time. So you might have a city that, or an issuer that has made climate commitments. We're going to be net zero by 2030 or 2040. And the green bond helps advance that commitment as well as build the new water treatment facility. So the municipal issuers are advancing multiple objectives. They are often strengthening their internal communication, and they talk about this. We learned a lot issuing this bond. The sustainability folks and the finance folks don't always talk, and through the process of issuing a green bond, they have to. And last but not least, they often say, my board loved it, my stakeholders loved it, my city council loved it. They're going to talk about it in their annual sustainability report. I wanted to speculate a little bit about how green bonds might look in the future. So we have a new ESG impact data product. We produce a score, an E, an SG, and a total score, and about 20 other data fields in Kestrel. And our data is on Bloomberg today. And we're measuring if there are risk mitigants incorporated in the bond financed activities. We're also evaluating if it's eligible to be a green bond or a social bond. And we're publishing that data in a data feed for investors now. So this might be the way that moves to the future. Today, we have about 11,000 series, over 100,000 CUSIPs, and $1.47 trillion that we've run through this analysis. And today, about 7% of the bonds we see in the municipal market are eligible to be green, but are not labeled. And another 17%, 17.4% are sustainability bonds. So those are green and social and not labeled. And then just lastly, another way things might change in the future is there's a new kind of certification that's available this year. It hasn't been used yet in the US. It's called climate aligned issuers. It's a new standard from the Climate Bonds Initiative, and it's possible we could have more climate aligned issuers who would be able to issue more green bonds more easily. So I really appreciate the opportunity to be here today, and thanks.
Yeah, don't go anywhere. Actually, we're going to bring Balian. You want to come back to the stage?
I closed this one. I meant to close mine.
No worries, no worries.
Sorry. Sorry about that.
Yeah, so come here and I'll sit behind you. So thanks to both of you for a wonderful paper and discussion. What I want to start with is a couple of minutes for Balian to make any response he wants, if you'd like hit the button and it'll be red.
Okay. Does it work? Okay. I just want to thank Monica for the fantastic discussion. She mentioned that green bonds may actually provide other utility other than satisfying people's non-peculiar preferences, including physical risk and also regulation, like transition risk. Regulation may actually change if you buy green bond, green assets, that may provide a hedge. Like a physical risk, some of the green assets may also provide a hedge for physical risk. And that's actually one thing we emphasize in the paper. In this setting, the results cannot be affected by physical risk or regulation risk because the green bond and their matches all have exactly the same cash flow, regardless of what will happen in the future, because they are, think of the same issuers, same coupon, same maturity, and same credit risk. Both are GO bonds. So the setting, we couldn't identify physical risk or a transition risk. And that's also the advantage of the setting, so we can speak more cleanly about green preference. This is not to say that the green label itself can create additional risk, but whether that's large enough or not, I don't know. It's possible that just by putting a label there could be some additional risk. And as I said at the beginning of my presentation, I know very little about this market. I'm learning a lot from Monica about verification and things like that. And also social bonds and sustainable bonds, they're not in our sample, and that's going to be, hopefully it's going to be in the next version of the paper. Thank you.
Okay, I see Mark Jaffe. And you should introduce yourself, Mark.
I'm Mark Jaffe. So looked at from the point of view of the municipal finance officer trying to minimize the cost of financing. The greenium has to be set against any costs associated with issuing a green bond. For example, the fee paid to the Climate Bonds Initiative or the fee paid to the validation or verification company. I was wondering if you know what those costs are, and do you think that they are a significant factor relative to the greenium?
I'll start. I do know what the costs are. I mean, in most cases, it's less than it's a fraction of a basis point. So if it brings in, we say if it brings in one new investor, it's worth it. And it gets more efficient over time with multiple bonds. So it's not expensive to do at all.
Yeah, I am Jaewon Choi from the University of Illinois. So I have a question to Monica. So when the bond is, say the green bond is issued and it's going to carry the certification, but I guess it will also happen that the municipality doesn't really follow up with the green project or they do something else. So in that case, do you see cases where the bond actually loses the certification? And if so, is there any market reaction to that?
The municipal market issuers are all operating in a very sophisticated and well-defined legal and regulatory framework. And so by the time they are issuing a bond for a new wastewater treatment plant or new county buildings or whatever it is they're going to finance, they've made commitments about what they're going to finance outside of that green bond designation. For example, new wastewater treatment plant has got a 2-year run-up permitting process where they have to make commitments about what they're going to build and how they're going to build it and what the outcomes are expected to be, and there's a regulatory framework around that. Similarly, City Council, in deciding to issue the bonds, is making a commitment. They pass a resolution, we're going to do this and in this way. And so those are just a few examples, but municipal issuers are very constrained. They're in design-build contracts that they can't get out of very easily. So you have some really good guardrails that will help ensure that they're going to build what they say they're going to build. Now, we also do surveillance on those bonds. If we've verified the bonds, we come back in and provide a report that says they did what they said they were going to do. But in general, in the municipal market, you can have confidence that they're pretty locked in. And I would say the cases of greenwashing in that way should be pretty minimal.
Jin Kim.
I actually have some related questions. So looking at your green label and stuff, right? It sounds to me like a bond covenant. Like, if you issue a bond, then you promise to investors that, your company is not going to sell some assets or do some certain things, right? So what is the legal implication of sticking to the plan as you say to get the certification? So if the certification breaks at some point, right? I understand that most of municipalities follow, what they wanted to do. But at a margin, we cannot rule out any possibilities that, things like that could happen, right? So in that case, what is a legal implication to that? And what is investors' point of view? What should they do about it? Thank you.
That's a great question, and I'm sure there are people in this room that are much more qualified to answer that question than I am. But I will say that part of the green bond process is there are sections to it, and one has to do with management of proceeds, another one has to do with reporting, and you really do see issuers, you see best-in-class issuers in the green bond market, right? And if they're not best-in-class, they're trying to be best-in-class. And so the process of issuing the green bond with an external review, the external reviewer works through those things to get to a reasonable level of assurance that these things are going to happen. And usually it's satisfied through the reporting. As for the covenant part of it, I can't speak to that at all.
Also, just a show of hands, has anybody yet seen a lawsuit in the muni market or in the corporate market related to not living up to commitments made at the time of a green, like, is this something that anybody has seen? Have you seen, so Steve, you've seen in corporate?
Well,
And you should introduce yourself.
I'm Steve Winterstein, formerly with Alpha Ledger, now with SP Winterstein and Associates. The only thing that I can recall was the disclosure problems that we had back, I want to say 2018, with Oakland, Marin County, I think Santa Cruz, and city of San Francisco, and I think I'm missing one. It might have been San Mateo, where there was a apparent contradiction of disclosure and versus a lawsuit against big oil. But that to me is probably the biggest landmark, and it was thrown out.
Okay, I think we have time for one more quick question. I saw.
Tim Keller, Mayor of Albuquerque, New Mexico. We'll see you guys later tonight. I had a question, I think, on Kestrel. We're in the middle of this process right now, and just appreciate also the market need for these kinds of certifications. Is exactly the problem we're having. But my question is, there's so much variability in the estimates for like energy savings for, let's say, especially efficiency. So around the leakage from buildings and so forth, on top of sort of the cost of solar panels and things like this. So the ranges we're getting for costs, from a traditional bond perspective, they're just way too big. So how are you helping cities, or how do you sort of mitigate that factor? Are you adjusting durations, or how do you recommend dealing with that, I think, inherent volatility right now when you're trying to forecast energy savings?
Green bonds for green buildings. The green buildings need to be built to, but not necessarily certified, built to satisfy a national or regional green building standard. So you would just tell your engineers that you need it to meet our standard. Our minimum standard is LEED Silver. So you would tell your engineers you need it to be engineered to meet LEED Silver at a minimum. And it's just an engineering thing.
Okay, thank you very much. Thank you, Monica. Thank you, Balian. Yeah. So you guys go down now, and we're going to transition to the next paper. So the next paper, the presenting author is going to be Jin-Kyung Ao from Yonsei University. The paper is Natural Disasters and Municipal Bonds. We're going to continue with the climate focus. And the discussant for that paper is Ivan Ivanov of the Federal Reserve Bank of Chicago.
Good morning, everybody. And first of all, I thank conference organizers to include our paper in this excellent conference. So the title of the paper that I want to present today is A Natural Disaster and Municipal Bond, and this is a joint work by Jae-won Choi, who's actually sitting right up there, and Tatiana and Tim Park. Okay, so natural disaster, flood, wildfire, disaster here, disaster there. I feel like I'm hearing all these words probably overly frequently these days. And actually, data supports my feeling. Over the past 30 years, the number of disasters and emergency declarations in the U.S. Has been growing at a rate of 7%, accounting for over 11 million per affected county. So what we actually want to learn about from this paper is, given this very frequent natural disaster and pretty economically significant physical impact in the county, what is the asset pricing implication of those events? So recent survey and papers actually document that although the climate risk is ranked as a top climate risk over the next 30 years, it is actually underestimated in the asset pricing markets. So why is that? A potential reason that we could give is that the detection of that in the asset, the risk in the asset market is actually not quite simple. For example, if you look at stock prices, then you're going to have to deal with huge compounding factors that you have to control. And also, most often, the climate risk, the proxy or what measures the climate risk is actually very slowly moving and gives very little statistical power to detect anything. So what we want to do in this paper is that we are going to investigate natural disasters and municipal bond market reactions to it. And we believe that that gives us a little bit better understanding about asset market implication of climate, natural, physical climate risk, the physical risk in the asset markets. So what we, to this end, what we want to do is we focus on municipal bond returns as opposed to bond yield or credit ratings. And there is a reason to it. Using the return actually gives us a certain benefit, such as we can speak directly to the portfolio performance of the wealth of the bond investors. And that gives us some high frequency level pattern of investors' response in terms of intensity and immediacy, while allowing us to sort of compare returns of the same bond composition before and after the event. So using the high-frequency return around this exogenous event actually alleviates certain concern about omitted value problems. Certainly, it gives us a little better or clear identifications. Okay. All right. You may think that the reaction of the bond market, muni bond market, regarding natural disaster might be obvious, but actually it is not. We actually do have papers that document that they actually have a positive long-run effect on the local economy. And also, moreover, the mechanism through which it affects the market, asset market, is actually pretty unclear. Is it, for example, expected cash flow, or is it, because of the discount rate, or all sorts of behavioral as well as liquidity demands? So we don't know much about that. So what we want to proceed in this paper is that we're going to split the sample in multiple dimensions that are correlated with the physical damage, but arguably uncorrelated with other factors. And we believe that that's going to shed some lights about our understanding about the mechanism, how the physical risk affects asset market. All right. So we don't really have that much time here, so I'm not going to spend lots of time in the data, but at a very high level, we have three sets of information. One is municipal bond data and local economy data, and also the information about the natural disaster. So we're going to combine all of this And so that is basically the data set we're going to work with. All right, so the biggest empirical challenge to work with muni bond return is that muni bond, you all may know, trades extremely rarely. So on average, muni bond trades less than 3 times per year, and that's going to make it impossible to perform a high-frequency analysis with a raw data. So what do we actually do about it? So our solution is that we employ the repeat sales approach, which is motivated by real estate literature, in which you face almost similar problems with housing market not being traded very actively, right? And we're going to obtain the weekly bond return for U.S. counties, county level, okay? So I'm going to actually, move into a little bit deeper about what we do with the repeat sales. So we are going to estimate county-level weekly returns. So it doesn't work with the screen, but the little RTC there is a county-level weekly return. So we are going to regress the low returns or log returns of the bond, individual bond I issued by the same county, and estimating county-level weekly return. So basically, we are regressing individual bond return on week-year dummy variables, effectively estimating the time-fixed effects of the bond issued by County C. Well, this sounds a little abstract, so I'm going to give you a little bit more spoon-feeding. So suppose that there are 3 municipal bonds issued by Montgomery County in Maryland, where I used to live. And suppose that there is bond A, B, C, right? And suppose also that there are 3 asynchronous trades from these counties. So first, bond A, for example, trade week 1 and week 4, giving us R1. And bond C, for example, trade twice, week 2 and week 4, giving us R3, right? Obviously, there are no subsequent prices and therefore no weekly returns from the raw return, right? However, what we want to do is we run the following regression to apply the repeat sales. So basically what we want to estimate is the R week 2, week 3, week 4, over the same county, basically estimating this system of regression equations. That's what we do. All right, so what is the benefit of that? So benefit of the data coverage. So using the repeat sale data actually gives us almost 35% of entire municipality that ever issued a municipal bonds, as opposed to less than 4% coverage in the case of the raw return. So with that, we're going to conduct an event study where we construct weekly cumulative abnormal return of that disaster-affected County C against 20 benchmark counties, in which benchmark counties are more than 500 miles away, with sort of certain matching conditions, with relevant variables. All right. So this week CAR or weekly cumulative abnormal return is going to be our main sort of dependent variable that we're going to investigate. All right, so how does it look like? So around the natural disaster, we actually do see that the price decline almost 31 basis point over 10 weeks, okay? So there are a few things that we can learn from this baseline results. So first, this 31 basis point, given that our in-sample weekly return, average weekly return is 0.1 basis point, is economically super huge, right? The decline, the magnitude of the decline is very significant. And also it takes a substantial time for asset market to reflect such a damage induced by natural disaster. But this is with a all bond, all uninsured bond. We separately look at the revenue bond and then find that this impact is actually more pronounced in the revenue bond. In the revenue bond cases, we actually see about 51 basis point price decline, as opposed to GO bond, which actually do not find anything. We actually do some robustness check with a monthly cumulative average return instead of the weekly, and we actually, we find something really similar. So all bond, 31 basis point, and revenue bond, negative 51 basis point, and GO bond, we find nothing. So we actually, interpret this result. The stark contrast between red bond and the GO bond is that it is something related with revenue diversification, right? So if the source of the revenue is undiversified, just like in the case of the red bond, then it actually has more impact from this physical risk as opposed to the GO bond. Just to reiterate, with a raw bond, raw returns, as you expect, we find nothing because we cannot really find any statistical power. So that reiterates the advantage of the repeat sales approach that we have. How about insured bond? So if the bond payoff is insured or protected by insurance policy, we actually find nothing. That actually suggests that such a price impact is caused by the physical damage as opposed to liquidity reasons or liquidity demand or behavioral factors. Just to give you a little bit more direct evidence that physical damage actually matters, we actually split the sample into two. First, more severe damage, more severe disaster, that is, I'm just going to say above median, and below median, which is less than average, less than median severity in terms of the disaster severity. And then we find that in the red bond, the biggest impact actually comes from a case where red bond faces very severe or more severe disaster, accounting for 61 basis point. It basically gives us more support about physical damage actually matters in this market. And if you undo that damage by FEMA transfer, which is federal disaster aid, then we see that we can basically undo all the effect when above median FEMA transfer is associated with very small or insignificant price impact, right? That also helps mitigate this negative shock. And what does it tell us is that the fiscal damage is actually the main drivers for all these actions. All right, so would then this ex post price reaction be priced in ex ante? To be able to see that, we basically measure investor expectation by prior frequency of historical disaster, okay? So if we actually look at the historical disaster, the below median historical disaster actually gives us much, much bigger magnitude and significance in terms of the price reaction, meaning that, if a bond from sort of counties located in a disaster-prone area, then all this price impact actually is somewhat, already implied in the price ex ante. And finally, just to give you a little bit more evidence about why the gold bond and the red bond are very different, we basically look at municipalities' leverage, and if even the GO bond, when it faces highly severe disaster, and if that issuer is highly levered, then the issuer has basically less room to maneuver to make up or diversify away such a shock. So it breaks the so GO bond actually becomes pretty sensitive as well. So, we actually repeat this process with the, revenue concentration directly, and we find something very similar too. So I'm going to conclude.
So we used the repeat sales methodology to study how natural disasters affect municipal bond returns. And municipal bond market responds negatively, but quite slowly, accounting for 9 million investor loss, which is actually quite significant given that average physical damage is 19 million in sample. Okay? And overall, our findings basically show that the post-disaster reaction is consistent with investors' rational reaction rather than behavioral or any subjective perception changes. That is all. Thank you very much.
Thank you. Okay, get started. It was really an honor to read this paper. It was great. I learned a lot. So I'm not going to go over this very much because I've already, like you saw the author doing a very nice talk. So just to summarize, like very, very quickly, you have this large adverse effect so on bonds of about 31 basis points after like an extreme event. And these returns come mostly from revenue bonds, right? So like geo bonds are mostly not affected, but you still have some effect among some groups, right, that may be affected for various reasons that I'm going to talk in the rest of the slides. And the authors touch a little bit on revenue stability, which is very like important for these returns being smaller. And finally, I think what I find one of the most interesting parts of the paper is that 8 tends to like mitigate these effects, and then they have also this like really cool part in the paper about ex-ante mitigation that also plays a role that I would like to see also played up a little bit more. Okay, so my comments are going to be around 3 areas. The first one is the economic mechanism. So let me start with that. So I know the authors do some of that in the paper right now by like splitting the sample into geo revenue bonds, but I would like to see more. Maybe one thing they could do is they can like flip things around and they could take the census like data and just like show us a full picture of what happens like in terms of financial statement information like of these entities. So like what I would look at here is like try to measure revenue stability in terms of the significance of property taxes or IG transfers as a share of revenues. I think there is some recent work that shows that a lot of the cities, county governments and so on rely more on fees, charges that are not as stable maybe. So I think that's what I would look at first and like explore other factors such as size and spending relative to revenues. I want to make a point here, leverage ratios are important, but they're only like important if they imply higher costs of like raising money or like inability to raise extra money, right? And I think oftentimes in the space what you see is higher leverage ratios mean that like you have a very large city which has raised lots of bonds and they're able to raise lots of bonds going forward too. And like last but not least here, I would look at risk, ex-ante risk of these entities, like in terms of agency ratings. I think it would be a good cut, and as we saw in the first talk, these ratings are important, so I think we have to take them into account. So I have a few other points that maybe we can talk afterwards because I want to get to the other points as well. Linkages, they're always important, but like we can like handle them later. Okay, so my second point is about county level aggregation. So my sense is that you like aggregate bonds to the county level. So of cities, special districts, school districts, like counties themselves. And I think that's done for like reason since like trading in the secondary market is like sparse. So I think that makes sense. I do think that we could learn a little bit more if we disaggregate the data. Like at least for some entities, you'll be able to find like information that's enough to estimate at least monthly returns. I think that should be like okay. I think right now what I worry is that this aggregation that we have places too high of a weight on the large cities, like relative to the other entities, because everything is also further weighted by power amounts in the secondary market. So I think I would look into that. I think we can learn a lot more from this. I think it's a really great exercise, and I think if we dig deeper, I think it would be interesting to see which entities are exactly affected here. So I would examine further heterogeneity in terms of the types of entities and basically which types of like investors derive these returns. Obviously, like right now, it seems institutional investors play more role, right? Because everything is weighted by par. But I think it would be interesting to see what happens to like retail too. Okay, so in terms of my last point here, I think I'm just trying to fit this within the economic mechanism. As the authors point out in the paper and in the slides, we have like lots of aid FEMA has done to like alleviate disaster like effects in these areas that are affected. And there's this really nice Fed paper right here that looks at positive effects. So it finds actually positive effects like after disasters, like in terms of all these factors like employment, wages, house prices. The house prices specifically would feed into most of the income these entities get, like counties and like local entities. So I am wondering, like, why do you find this adverse effect, right? And so I think if the long-run effect is likely to be positive because of this build better hypothesis, I think it would be interesting to see the exact entities that drive these results. And I think you show some of that in the paper. We basically show that these effects come from the areas that have low or no aid, which is very like cool, right? Like because this, like you have this setting, these entities that are affected, but yet they don't get any aid. So I think what I would like to alleviate here, this concern that some folks might have, is that these are the areas that face less severe events. So I'd like you to do a little bit more on that and what the external validity of this may be, right? Like, because, I mean, how can we apply this to a broad sample and like for, I think, the majority of U.S. counties? So I think I may have some ideas here, so you could look at maybe some discretions in the FEMA declarations, and I think you don't see much of those recently, but like you may be able to see more like going back like in time, and you have a very large sample, which is pretty nice since 2005, and I think maybe there's some discretion like in terms of like which areas the state picks, right? Like because the way I thought this works is like the state would select the counties, and then like FEMA would have to like endorse them. But I think maybe the states have some discretion to not pick some counties and pick others for various reasons. So maybe this is something that you can do. So that's all I have here. I really like the paper. I think it's an extremely important paper in an area that we need to know more about. My main comments here that I want to learn more about where these are coming from, and I think this would be an amazing paper that I would love to read again, like when you have another draft. Thank you very much.
So I want to start by giving Jun Kyung a moment to respond to anything that Ivan said. Hit that right there.
Thank you, Ivan, for the very encouraging comments and very helpful, very well thought out comments. So let me just I'm not gonna be able to respond to all the comments that he has, but a couple things. So the census idea actually is quite good. So I think what you're actually getting at is basically behind of those county fixed effects that we have. So we actually control everything by county fixed effects. So if the revenue stability is somewhat time consistent, right, then it should be observed by time fixed effect. And then, we actually haven't looked into what's behind of the county fixed effect. And that is a great suggestion. So we're going to definitely take a look at. And in aggregation is that, so you're right about the weighting schemes that we have. So we actually do have not OLS but WLS regression, and estimating this repeat sales, basically giving higher weights on more frequent or larger bond transactions. So the reason behind of this is that we thought that it is more informative, right? So if bond is very thinly traded, and if we're basically trying to give a bigger weights on larger trades and the more frequent trades. And FEMA transfer, we actually, at least I actually haven't thought about discretionary effect of the FEMA decisions and then state designations and stuff. And that's something that, definitely we're going to take a look at and learn more about it. And I'm going to, ask him about some technical issues probably outside of this conference room. Thank you.
So I'm going to ask my own question now, and I'll preface it with, my first job out of college was working the very most junior employee at the Federal Reserve in the entire system, and one of the things I had to do was collect data on onion prices, and we were trying. So we were trying to make an index of onion prices, but there are a million different kinds of onions. You've got Vidalia, you've got imagine, and just. There's a cycle of the onion market where for a few weeks you'll have Vidalia onions, and so we tried to create a repeat sales onion price because we want a long horizon index of onion prices. And one thing that matters for that is that there is a life cycle of the onion, like the Vidalia onion comes in the market, and there's sort of a tendency for the price to kind of follow a life cycle. And one of the things that I'm thinking, what you're doing here has the potential to be really transformative because a lot of researchers, we really want a measure of long horizon county, unit level municipal bond performance. But if there is something where there's kind of a life cycle of a municipal bond where it's issued and there tends to be this sort of, it's placed and then it seasons, and one thing that I think the power of this potential methodology means that we need to kick the tires a lot. And when you use this and then you say, if I change, do I end up with something that looks like a price that makes any sense at all? That's my question.
Yeah. Okay. I actually didn't know that people at the Federal Reserve spending this much time to come up with something really good with the onion prices. Probably why not for corn prices or oil prices, why not, right? So basically what we're trying to build up here is that, okay, so you can actually apply this methodology to many different illiquid assets, right? But, when it's applied in the muni bond market, essentially what we can have is an index of muni bond per county level or at city level or any municipality level, right? So I believe that, indexing something basically gives us a lot of application in many different layers, I guess, right? So for example, you can, come up with just being very creative here, right? So, come up with some ETF of Montgomery County Muni Bond Index or something like that, right? So you are actually able to translate something really illiquid into something very liquid asset, basically capturing on those aspects. So we're very excited to see any other application that we can build up on here. Thank you.
Hi, Tracy Gordon, Tax Policy Center. When I had a job slightly less glamorous than Dan's as a research assistant in graduate school, I spent a lot of time thinking about housing and housing price indexes. And I guess the comparable concern here about repeat sales is the starter home, which transacts very frequently. And from what I gather from our friends at this conference, it's the 5% coupon bond that transacts very frequently because institutional buyers like it. So I guess you're saying you want to capture that increased activity, but it's clearly not representative of the whole market. So what we used to do in real estate, in this real estate context, my advisor was John Quigley. He pioneered this idea of a hybrid approach that also used hedonic regression to try to get at these systematic differences between the properties that you see transacting very frequently and the rest of the sample. So it's kind of getting the best of both worlds. At a minimum, I would love to see just a summary table showing the statistics for the highly transacting bonds and the rest of the sample.
Absolutely. I'll keep it in mind. And please expect the next revision for that summary stats.
Hi, this is Adam Bloomfield, economist at the FDIC, previously SEC. One just sort of framing question about the non-behavioral angle, the idea that the insensitivity of insured bonds, right, rules out the behavioral effect. To me, I'm not as convinced versus if you were to look at something more hard, like default rates, like the change in expectation in relation to actual defaults or risk ratings, which is what Yvonne said. To me, I think there still is a way to frame this as a behavioral phenomenon, even if you see a differential insensitivity. So that's one comment. The second is just a quick clarifier about geographic ID. I know when wrestling with these kinds of data years ago, something that was hard was that from the CUSIP-derived geography, that these bonds are often issued by some sort of central conduit that are quite distant from the actual location of the beneficial owner. And how do you deal with that? I apologize if I didn't catch it in the paper, but it's something I'd be interested for you to mention.
Yeah, that's a very nice question. So let me just answer. So you asked two questions, so I'm just going to answer in a separate fashion. So first of all, the insured versus uninsured is not the only evidence that we have about behavioral factor is not the main driver. For example, take a RAP bond and a GO bond, right? For if you are just for whatever reason you're just really nervous about anything about or uncertainty about the future of the county, or if you face some liquidity problem that you're going to have to sell your bond immediately because your property in that region is destroyed by hurricane or flood, whatever, right? So then, we shouldn't actually expect to see the price impact is only concentrated in RAV bond instead of GO bond, right? So we do actually have a series of evidence that actually tell us, certain consistent way that the muni bond market is actually quite rational than we might expect. That's basically kind of things that we want to deliver here, okay? All right, the second one is you're quite right about the location. So location is actually very hard to actually, to collect. So basically what we did is, instead of going to a QSIP level, QSIP owner's location, so we actually used the Moody's data. So we actually scraped the entire Moody's data that actually gives us a little bit more color and then taste about the location of who's actually the issuer of those bonds. Yes, I hope that clarifies your question. Thanks.
That's great. We've hit the end of our time. I hope you'll join me in thanking Jen Kuhn and Ivan.
Thank you, Dan, for doing such a good job of keeping us on schedule. I want to explain the logistics, but first, I want to say how rewarding these 3 papers were and how close we came to achieving the goals for the conference, which is to create a community where scholars who work on rigorous work on the muni bond market can interact with people who make their living in the muni bond market in the hopes that we can get better research. And then we have people like the mayor of Albuquerque to make sure that what we're doing makes sense to policymakers. So I think this was a great example of that, and I thank all the authors, discussants, and the people who asked questions. All right, so here's what we're going to do. There are box lunches outside here, and you have a choice of 4 rooms. And I hope, is there signs out there somewhere? Yeah, good. So one group is going to focus on state and local budgets and credit quality. It's going to be moderated by my colleague Louise Shaner, and that's on the 2nd floor. You go back to the security desk and up the stairs.